Hello, thank you for joining me. In today's video, you will be exposed to how one can profitably invest in an economic recession. Now let's get right into it. Everything said in this video is for entertainment purposes only and is just us acting as your source of interesting information. We recommend that anyone considering investing their finances conduct active research before putting their money on the line. Warren Buffett, widely regarded as the world's most successful investor, seldom modifies his long-term value investment approach. Down markets he sees as an opportunity to acquire strong firms at reasonable rates. We'll go through Warren Buffett's investment philosophy and stock selection criteria in this post, with a focus on how they may be used in a down market and slowing economy. Things to note. Warren Buffett is one of the most well-known and successful investors of the modern period, surviving even the worst downturn markets. Buffett's investment strategy has been to look for intrinsic value in a company's long-term competitive advantage, as well as a few other factors. As a result, a bear market might be viewed as a chance to buy shares in valued firms at a discount. Quick overview on Warren Buffett. For the first 50 years, Warren Buffett has led investment firm Berkshire Hathaway as chairman and CEO, guiding the company to extraordinary market-crushing profits. He's seen it all, and he's kept a level head to put in amazing performance in both good and bad situations. On August 30, the Oracle of Omaha turned 90 years old, establishing himself as one of the history's most successful investors. Buffett has observed 8 distinct recessions for the U.S. economy during his tenure as Berkshire's chairman, including the one that began in April. So, during the present economic slump, who better to turn to for advice? These 3 principles from the world's most famous money manager may be able to help investors weather the storm and lead their portfolios to large long-term returns. 1. High-quality firms beat low-cost stocks. It's far better to acquire a great firm for a great price than a good company for a great price. That remark is on the short list of Buffett's most famous investment quotes, and it goes to the core of a stock-picking basis. That's especially crucial to remember during a downturn. Stagnant firms are frequently shaken out during recessions. While the stock market has recovered from its March fall, with indexes such as the S&P 500 and the NASDAQ recently reaching new highs, there are still areas of economy that investors should be aware of. Under the strains of COVID-19 and the present crisis, unemployment is rising. Businesses are scaling down on expansion efforts, and consumer confidence is shattered. Stocks supported by solid businesses with long-term competitive advantages should be prioritized by investors. It's easy to get caught up in the allure of low profit sales or price-to-book multiples when analyzing a company's value. But these indications can be deceiving if the underlying business is in an irreversible downturn. Buffett is known for being a value investor, but selecting excellent firms has nearly always been the starting point for Berkshire Hathaway when looking for equities with favorable prices. 2. Difficult times might be excellent times to purchase. Buffett and Berkshire Hathaway's market-crushing success has been attributed to their propensity to purchase aggressively amid sell-offs. As the Oracle of Omaha famously put it, an investor's best buddy is bad news. It allows you to get a discount on a piece of America's future. Investors are correct in looking for triggers for possible volatility in the present recession, market pressures connected to the coronavirus, and other headline-worthy stresses. On the other hand, the U.S. industry appears to be in good shape, and stock market downturns have traditionally provided good purchasing opportunities. To use another Buffett adage, it pays to be greedy while others are afraid. Of course, investors must keep in mind certain distinct characteristics of the present recession. Unlike in earlier recessions when economic downturns were accompanied by a substantial and sustained decline in stock prices, the stock market has shown to be unusually resilient this year. While fears about the coronavirus triggered sharp sell-offs in March, the market's subsequent rebound was unprecedented. Investors should stay away from equities where the market appears to be overvalued. But the current downturn should continue to provide valuable chances to acquire long-term positions in good firms. 3. Take a long-term investment strategy. Buffett is famous for saying that the best time to keep stock is forever. Focusing on stocks that are poised for ultra-long-term success will drive you to examine a wider variety of possible outcomes and apply tighter investing standards. A buy-to-hold strategy will also save you from losing out on stock's finest days while simultaneously putting you in position to profit from broader market momentum. Over the previous decade, if you had invested in the SPDR S&P 500 ETF and kept it, you would have received total gains of more than 300%. The funds would have returned more than 1,150% if you had kept it for 30 years. Berkshire Hathaway's Class A stock, on the other hand, has returned more than 2,400% during the same period. If you're prepared to be patient and let time work in your favor, even the most conservative investments may provide huge profits. Thank you for watching this video. Make sure you subscribe and hit the bell button to get instant notifications when we add new videos in the future. Don't forget to like and share the video with others so that they can benefit from it. Thank you, and see you next time.